If you treat saving and investing as the same thing, you can be missing out on a lot of dollars and a lot of money moves, which is why in this video, I'm going to break down the key differences between saving and investing, when to use each, and how to balance both. But before I get into it, hey girl, hey, my name is Jocelyn and I am the founder of Maximize Money, where I teach 9-to-5 earning women how to create their dream lives with their 9-to-5 income so that they can do more of what they love without trading their time for it or going deeper into debt for it. And as I mentioned in this video, we're going to talk about the key differences between saving and investing and when you should be doing both, okay? Or one or the other at one point in your life, but essentially both. So why does this matter? You're like, well, girl, I already know the difference between saving and investing. Sure, so did I. I thought I did too, but people tend to confuse the two. Or they only just do one, or they assume that both things are going to be working the same, but they're not. Saving, when it comes to saving is essentially you setting aside money for the what ifs. You know, this is money that you have access to. It's liquidity, meaning that like if you needed to get to it, you can get to it in a quicker environment, a quicker way than saving, you know. Usually it's also connected to your checking accounts. It's connected to your banks, like most banks offer them, you know. Now, what I recommend, and be new here, then you might not know this, but for my regular community, y'all already know I'm a big fan of high yield savings accounts. High yield savings accounts are low risk. They do not require you to invest the money. Once you put it in there, it's just going to grow, assuming that the APY, which is their interest rate that they pay you for opening the account, they are just going to pay that, assuming that it's going well. Now, what you should be using these accounts for are a few things. Number one, emergencies. I recommend to my money girls, which are my clients, to have at least 3 months of emergency savings, meaning 3 months of your living expenses. Put it in a high yield savings account. People feel like 6 months, especially in this economy, it's tough to find a job these days. 6 months is a lot, but if you could start and aim for 3, that's a good place. And then after that, then I'd recommend them to start investing. But for emergency savings, I also encourage it for the fun that you like to have. If you are a traveler like me, I like to travel, baby, year round. So I have a high yield savings account that is strictly for my travels, okay? It's called, what did I call it, child? I think it's called enjoyment. Because it's like, that's my key area of enjoyment. So instead of me, the old me, baby, the old me used to run it up on my credit card. That's how I ended up in $10,000 in credit card debt. I would just spend. I'm like, you know what? I could use a trip. Or my friends would invite me on a trip and I didn't say no. But what I realized is I would come home and I had to figure out how the heck I'm going to pay that off. And I never did. I would just pay the minimum balance. And I just got sick of that. And that's why I couldn't afford to freaking live on my own, okay? So don't be like me. Baby, be better. That's the old me. The new me now set aside money from every single check. Every single time I get paid, I set aside a certain amount of money for my high yield savings accounts enjoyment fund, because life is meant to be enjoyed. And the last thing I want to do is be worrying about how I'm going to pay for something when I could have just been a good steward of my money and used this high yield savings account, which pays me to set it aside to do what I need to be doing anyway, which is save money. And they pay you between 3 and 5% interest rates. It's called the APY. But the, think of it as interest that they're paying you, okay? So that is the difference with saving. You know, save for fun, save for emergencies, save for stability, okay? It's just in case we get laid off, just in case you lose your job. Have something that you can fall back on so you ain't trying to rob Peter to pay Paul, okay? So some of the pros to a savings account is that, again, it's low risk, no risk, essentially. Like, that money is always accessible to you. But I recommend you get a high yield savings account. But that money is always accessible to you, even with the high yield savings account. It's also, gives you a peace of mind. You don't have to overthink whether the money's going to be there. The money is going to be there. Another great thing is that it allows the money to grow more than it would at a traditional bank account. If you are new here, or if you're not new here, baby, watch my video on why you should stop leaving your money all of your money in bank accounts, because the money's not working on your behalf, and your money should be working for your behalf. You work hard for your money. We work hard for our money. It should be working on our behalf. So I'll make sure that that's linked somewhere. I'm gonna link it in the description. The stop leaving your money, all of your money in the bank account video, because that's gonna be a good kind of refresher for the girlies. Some of the cons to just savings accounts are, low returns. If you are saving your money in a regular savings account, baby, you're not earning nothing on it. You're probably earning pennies because the APY for the regular traditional savings accounts are usually like 0.003, 0.004. And if you want to fact check me, baby, download your savings statement, come back, comment below, let me know what your APY is. Now, if you have a high yield savings account, comment below, let me know what your APY is, okay? All of this should be found in your online banks, but I want you to see what the difference is in the comments below. But ultimately, like, their returns are a little lower than they could be, and that's why we're going to talk about investing on this channel or in this video as well. And then, unfortunately, it is not outpacing, inflation long term. So, yes, it's nice to get a couple of, dollars here and there. I love it for myself personally because that means that when I withdraw the money, I'm withdrawing more money than what I started with. But the only way to truly outpace inflation is through investing. So those are the pros and cons of saving. Now let's talk about when you should be investing and how. So investing is essentially using your money to buy assets that grow in value over time. So that can be a property, that can be buying stocks and bonds, that can be fine art, it can be watches. Now I don't recommend those. I recommend stocks and bonds. That's what we're going to talk about primarily here. Stocks, bonds, ETFs, which are exchange traded funds, which is essentially a bag of stocks that you purchase for one process. Index funds, which operate similar to ETFs, they tend to have a minimum deposit. They don't trade as frequently as ETFs as well, which means that when you buy it at the net asset value price of the day versus the ETF that can change according to what's happening in the stock market. Those are the different ways that you can invest, and they have to be invested in specific investment accounts. So some retirement accounts at our companies can be 401ks, 403bs, even HSAs, which are health savings accounts. And then outside of our 9-to-5s, you can use Roth IRAs, you can use just regular brokerage accounts, online brokerage accounts. I have all of the above. Okay, I have all of the above because I'm serious about making my money work for me, growing my money so that my money is going to allow me to retire at a decent age. Like, I'm planning to retire, if the Lord says the same, in the next 10 years. But I'm also very aggressive with my investing, y'all. So it's good for long-term wealth building, allowing your money to grow without you having to work for it, because you take the money from your 9-to-5, you invest it in the appropriate accounts, and then you purchase investments in those accounts, and you just set it and forget it. You monitor it. You don't want to just be out here closing your eyes to it, but like, that's why you do your research. That's why you understand what type of investor you are. You understand what type of investments that are out there. You understand when you want to retire. You understand the lifestyle that you want to live. And those are all of the things that I ask my girlies in Money Girl Collective. Money Girl Collective is my 12-week program for women that are serious about becoming investors but don't know where to start. So they have questions about, okay, what do I invest in? What account should I be using to invest? Like, how do I track it? Like, do I have enough money to start investing? And my answer is always yes, baby. You don't have to have a certain salary to start investing. You could be investing right now at your 9-to-5 if you knew what to do with it, And so, like, all of those things are debunked. And we spend 12 weeks meeting every single week to basically lay the foundation for building your own personalized investment plan, y'all. All the questions that you have about investing, whether you realize you have the questions or not, we do it in a small group. It's live. It's not something that you have to go through on a course. Like, I meet with you guys every single week. You ask me questions in real time. I answer you in real time. And we are literally building this thing together with education being first. I don't want to tell you what to invest in and you don't even understand what to invest in. I want you to show, I'm showing you how to read a prospectus. I'm showing you the difference between Microsoft and Apple stock. I'm showing you what an ETF is. I'm taking you behind the scenes so that you understand how to build an investment portfolio and you build one that makes sense for you and your lifestyle. Okay, so no portfolio is going to look the same because we all make different salaries. We all have different goals. We all have different dreams. But the educational component is going to be the same, okay? Now, how you apply it to your life is going to be different. But I'm so adamant about creating more investors that look like me, okay? More women, more black women, okay? Now, Money Girl Collective is not just for black women, but it's for women. So, sorry, guys. Y'all got to find somebody else. Women only. So, some of the pros to investing is you get higher returns. So, traditionally, Historically, the stock market, the returns are between 7 and 10%. That means that your money has an opportunity to grow between 7 and 10%. Now, there have been years like 2023, I had a 23% return, okay? Which is wonderful for me. But I've also had years when it was only 7%, when it was 5%. Like, investing is a risk, but I'm so thankful to have started when I did. And if anything, I wish I started sooner. If you are in your 20s and you watching this, baby, you are in the prime time, because you would be starting early, which means that you're not going to be working forever, because your money is going to be working for you. And eventually you're going to have enough money to live off of, because the money will have grown so quickly, you know? Now, if you're in your 30s like me, it's not too late. If you're in your 40s, it's not too late. The key is to start, y'all, because you want to take advantage of compounding interest, which means that your interest is earning interest on top of itself, okay? Earning interest is a game changer, and it's not something you can get with a regular traditional savings account. I'm sorry. That's the con of it, you know? And ultimately, lastly, a pro is that you're beating inflation over time, because as cost of goods grow, the value of your money should grow as well. And investing is a great way to ensure that that happens. Now, some of the cons, because this is a stock, it's investing, baby. There is an opportunity that you could lose some money. It is what it is. But no risk, no reward. That's just, it is what it is, you know? Have I lost money? Yes. But has it impacted my lifestyle? No. That just means that you have to just continue to monitor what's going on, and then you make decisions based on when you feel like, okay, maybe I need to sell. Maybe I need to just stop buying some of this. Maybe I need to look into some other stocks that are performing well right now. Like, you'll know what to do. If you a Money Girl Collector, baby, you're going to know when it's time to pivot and how to pivot, okay? Join it. Link in the description. The wait list is available, it's open, and I will be opening the doors officially in October. The con as well, another con is market volatility. The market be going crazy, okay? Now, I teach you how to be an emotionless investor in Money Girl Collective, and just how to monitor your investments without being so emotionally attached to them. And that's why having a savings account is key. A, hello. And B, understanding what an investment is and what type of investments make sense for you are so important. Again, this is why Money Girl Collective exists. I'm taking a lot of the stuff that I learned over these last 5 years and condensing it for you, so that you don't make the mistakes that I made or wait forever to start investing. And then 3 is that it's not liquid, which means that it's tied to your retirement accounts at your job. It's tied to your Roth IRAs. And if you take it out, there can be some penalties associated with it, or you do have to pay an early penalty fee. And we don't want that. We want to know that, okay, I have money to live, I have money saved, and if I take a little dip, you know, it's okay, because the beauty of stock market investing is that this is literally what it does. It just goes up and down, up and down. So once you remove the remote emotion from that, and you understand the history and the ups and downs and the ebbs and flows of investing, you'll feel a lot better about the decisions that you make. So that's it, y'all. The difference between saving and investing. So again, when you think about like when to save, when to invest, if you are going to need the money within the next 1 to 3 years, if you need just 3 months of expenses for your emergency savings, if you are preparing for something that you know is coming up, like buying a house, buying a car, taking a trip, a savings account is going to make the most sense for you. Specifically, a high yield savings account. And I linked mine in the description. It's called Marcus by Goldman Sachs. Their APY, their interest rate that they are paying as of the date of this recording, is 3.65%, which means that your money has an opportunity to earn 3.65% on whatever balance you leave in there, assuming that APY doesn't change, which means you're going to be getting a couple of dollars if you're doing what you need to be doing right. And that's money you do not have to work for. It's not an investment. Now, if you want to invest, you make sure that you invest when you know you won't need the money for at least 5 years. I don't teach trading. I don't teach crypto, Bitcoin, stuff like that. Like, I teach long-term wealth building in Money Girl Collective. So if you are like, no, like I want to get the money out next year, then it's not for you, baby. You need to be sticking to saving. If you are saving for retirement, if you're saving for, you know, your kids' college tuition, if you're saving for longer term goals, you know, investing is good for you. If you want to grow your wealth and, you know, beat inflation, which means that the value of your money is not losing, but it's actually gaining and keeping up with the overall cost of inflation, then investing is good for you. So ultimately, long story short, make sure that you are saving first for stability. Make sure you have at least 3 months saved in your emergency savings account, your high yield savings account. Use Marcus, linked in the description. And then after that, after you covered your day-to-day expenses, you living comfortable, you understand and manage your money well, then you can start investing, you know, but only if you don't need the money for at least 5 years. But I would say 3 to 5, maybe. But I don't plan on touching my money for the next 10 years. Again, because I'm focused on growing the money. And if I take it out, then it defeats the purpose. I want to retire. I want to make work optional, baby. I work a 9 to 5 just like y'all, and I run this business. I want to make all of this optional. I want to make all of this optional, and I want to have freedom to do what I want, be where I want, and have the money to do that, you know? I don't want to be working for my money forever. And one of the tried and true ways to grow your money is through investing, you know, and grow it passively, meaning you don't have to show up to work. You don't have to run your business. If I wake up tomorrow and I decide I don't want to do none of this, my livelihood wouldn't change because of investing. Now, right now, I can't do that. But in 10 years, baby, maybe 5, if God says the same, like, I will have an option to do this stuff. And that's the beauty of investing. So you understand your why. You understand why you do these things. And it gives you an anchor. You know, it helps you to choose the right investments, choose the right accounts based on when you want to retire, based on if you want to make work optional, based on if you just want to have an additional stream of income. All these things are discussed in Money Girl Collective. So click the link in the description, baby, for my 9 to 5 earning girlies who ready to start investing, baby. Baddies have investments, savings accounts. Like, we not going into debt. We not living off credit, baby. We are funding our dream lifestyles with the money that we're already making now. So find the right balance. Save first, invest later, and then just make sure that you do a combination of both once you're living comfortable. So thank you so much for watching. Please like, comment, share, subscribe. Let me know if you're investing. Let me know what type of accounts you have, you know, and share this with someone that you know is looking to take their finances to the next level. So I'll see you guys on the next one. Please like, comment, share, subscribe, y'all. Peace.